Hello everyone and welcome to your Glassnode video update for week 11, 2022. Today we're looking at a fairly interesting market structure which is really consolidating, and we're seeing a bit of a discrepancy between the short-term impacts and the longer-term impacts. So we're really going to unpack this across a number of things, both in terms of spending patterns, accumulation patterns, and what we're looking at here is trying to assess our different time frames, understanding how the market is operating, what the accumulation looks like in the near term, and then again in the longer term. So the accumulation trends in the very near term have softened somewhat. We've seen a little bit of spending going on from some of the older coin cohorts. These are normally synonymous with what we would classify as the smart money. They're people who have seen all of the volatility and their experience with how the Bitcoin market moves. Now, conversely, we've got those longer term investors who remain high conviction. We're seeing extremely high rates of accumulation, particularly when we look at this on an annualized rate. How much accumulation has gone on over the last year, and is that trend continuing to strengthen, which in most cases it is. So it's quite an interesting market. It really shows how the current geopolitical and macro headwinds are really weighing on the short-term sentiment. People are just not really sure how to feel, whereas at the same time, there is that consistent baseload of hodlers that we've talked about over recent weeks. So it's a very interesting market structure. There's a lot going on at the moment, but we're really going to try and break this down into both our short and our long-term perspectives to try and just understand what may be going on in these different timeframes. So just before we kick off with the analysis, please do give us a like and a subscribe on our channel. It really does help us get to all more eyeballs. I hope that you're enjoying the content. You can always let us know in the comments what you are and are not enjoying. So we've got our market structure here where you can see we are compressing into this little triangle here, which is now over 2 months long. It's starting to look somewhat similar in length to what we had back here in May, June, July. So really we've seen that the bears haven't yet been able to break to the downside, but simultaneously, every time the bulls have tried, they've been squeezed back down. So it really does show that macro uncertainty. Now, we released this week the accumulation trend score. This is a new metric available to our advanced members, and everybody can see it at the moment. So it's certainly a metric I would recommend checking out. And we did do a video guide on this last Friday. Now, what we can see with this metric is in the purple zones, this is where we essentially have a large amount of accumulation. And this is both including whales, so it considers how large the participants are, and also whether we have a large proportion of the market adding to their balance. So you can obviously have one whale adding coins, or you can have a large number of smaller people also adding coins to their balance. So purple signify this accumulation. We saw this in the first half of the bull. We saw a opposite of that, this distribution phase at the top, which in hindsight shows that investors were less interested in accumulating up here in the period up to the Coinbase direct listing. We then had a softer period of accumulation throughout all of 2021. And it really was only in the October, November through to January period that we saw a large amount of accumulation. Now, remember that we saw most of the tourist people who are here just for the price and the hype get flushed out in May. So really, these buyers up here are more likely longer term investors. They're people who are fairly price insensitive, and they typically they're more experienced with the market. They're not here just for the hype. They're here because they believe in Bitcoin. Now, I mentioned before that this week is a little bit softer in terms of the accumulation, and we can see this. We had this somewhat purple mark through the first half of this consolidation, but it has softened, and we're now getting values around 20%, 10%, so it's on the lower end of this particular metric, and it's showing that in the recent weeks, there's a little bit less conviction in the short term. It's showing that that overall macro headwind has softened the demand somewhat. Now, we then look across to, we've got two metrics here. One is our 90 days coin days destroyed. So for reference, we consider the amount of time that a coin has been dormant or inside an investor's wallet and unspent. We call that lifespan, or we measure it in the term called a coin day. One BTC dormant for 1 day will generate 1 coin day. Now, as you can expect, and what we saw in the first half of this bull, as we see those older investors actually selling their coins, they're generally coming from older coins, right? So we see more coin day destruction. This is looking at the 90-day sum of coin day destruction. We see more destruction going on during the bulls when people are essentially liquidating coins they bought 1, 2, 3 years ago and taking significant profits. Now, during the 2021 period, we saw this metric really start to decline. This is showing that we've got a reduction in the amount of coin day destruction that's going on. And you can see here that we're starting to form this sideways baseline pattern. And you can see that this is much the same as our 2020 period, which is also kind of like a pre-bull accumulation phase where very few older coins are coming back onto the market. It's typically driven by people who are actually buying coins that are sold by speculators and taking them off the market. But that accumulation takes time. As we've now seen, this has been going on since July of last year. So we're in a significant period of time that looks like a consolidation pattern. You can see that even though we've had softer accumulation, we're also not necessarily seeing a huge amount of coin day destruction, which means most of the coins that are on the move are more or less younger. However, there are still some of those older coins coming back into circulation. So this is where we bring in the binary coin days destroyed. So remember, coin days destroyed is looking at how much lifespan has been spent on a particular day. Now, if we run this over a long period of time, or Bitcoin's 13 years, we have a long-term average. What's a normal period of time? How many coin days do we expect to be destroyed on any particular day? Now, what binary coin days destroyed does is, and I've applied a 7-day moving average here, which can show you these kind of profiles. It's a bit more of a trending indicator. When we have more coin days being destroyed than average, this metric will trend higher. Now, because this is a 7-day moving average, when this metric is at 1, it means that for 7 consecutive days, we've been destroying more coin days than average. So it's showing that older coins are coming back to life. And you can see that this large cluster of coin days destroyed 90 correlates with a large period of coin day destruction. And you can actually see that this carried on all the way through the topping pattern. So even though we were having a decline in the net number, the total 90-day sum of coin days being destroyed, it was still persistent sell side pressure. Now, we saw a little bit of this sell side pressure again that put in this top. So you can use binary coin days destroyed to identify when some of those older coins are coming back to life, and or when you've got lots of coin days coming back to life. So remember, it's the same as the whale analogy. You can have one guy that's got 10 BTC from 5 years ago, or you can have lots of people who have coins from 5 days ago, but there's lots of them. So they can equally add up to the same number of coin days. So really, it's an indication of overall sell side, but measuring it through time rather necessarily than just through BTC volume. And you can see that we have had a slight uptick recently. Again, it's not like it looks like at the moment, but it could very well turn into a bit of a trend. So this is a metric to just pay attention to over the next couple of days and just see whether we get a decline in binary coin days destroyed, or if this actually does continue to trend, potentially indicating that that sell side pressure remains. And we can see this here on our spent volume age bands. Again, this is another advanced metric. And what we're looking at here is of all of the volume from 0 to 100% of all of the transaction volume, how old are they? Now, typically speaking, we can see in this bull market period, we get more of these purple coins. You can see the purple comes to life during that period of time. And when the purple is coming to life, it's showing that we're getting older coins in general. The converse of that is what we saw back here during the August rally, a lot of very, very young coin days. What we're seeing is that most of the coins that are being spent are fairly young. Again, they're early speculators, they're people who are trading in and out of positions, and we only saw these purples start to pick back up near the top, which again correlates with our binary coin days destroyed metric. So we have a number of things that are telling us the same story, and that helps us build conviction and confidence. Now we can see there's been a little bit of these purples come back to life, but really a lot of it seems to be in the oranges, which again, we're talking about a couple of months old coins. Now it makes sense. Some of those folks who bought recently thinking it was the dip, it turned out to not be the dip, and we've had a number of dips ever since. So it makes sense that some of those couple of month-old coins would be coming back into circulation. And even so, if you're a long-term holder, quite often, if you did want to de-risk, you'll be selling the coins that you most recently accumulated. Many people will leave their cold storage in place and they'll de-risk using their most recent coins. So it does actually make sense. And also when we combine the fact that lots of these folks did in fact buy up here in this topping section, it makes sense there'll be a little bit of distribution coming from there as well. So overall, to summarize this section, it's a little bit more bearish than it was last week. However, it's not something that's too scary just yet. But at the same time, we have to remember that price is squeezing into this triangle, and quite often this is when the market decides to move and commence some kind of trend. After a long period of consolidation, we typically get a move. So there is that kind of potential for it really to go either way, and the bulls or bears really need to prove which direction they're going to take this market. So to kind of explore this idea a little bit further, We've covered in previous videos that short-term holders, these are coins that are younger than 5 months, 155 days. They are the most likely to spend. And this is on a statistical basis. We actually look at all of the UTXOs in the entire Bitcoin network, and we've mapped out what is a typical time period that's highly likely to spend and after which is less likely to spend. And it turns out that it's somewhere in the realm of 155 days. So therefore, we classify the long and the short-term holders, where the short-term holders is a statistical or a cohort that we use to say they are the most likely to sell. Now let's add in another layer to this, which is the total short-term holder supply, coins held in a loss or coins held in a profit. And you may have experienced this before. There's kind of two extremes that's going to make you likely to sell your coins. The first one is, are you in an extraordinary amount of profit? Because you see a big green number, the likelihood of you wanting to sell those coins and realize those gains goes up. Now, the other side of that is if you're underwater and you're seeing your coins be underwater and your position is in the red for a long period of time, you start really feeling like maybe I should just capitulate and exit this position. So you may have experienced this feeling in the past. Now, what we've got here on the left is the short-term holder supply in loss and the short-term holder supply in profit. And what we can see is that there's unfortunately not many of these short-term holders who are in profit, 197,000 BTC, which is a large amount. But remember, most short-term holders are currently in a loss. This is much, much higher up here at 2.5 million coins. So there's a significant amount of coin supply held by the cohort that's the most likely to sell, who are also in the red. So there is a possibility that this is kind of the potential energy, so to speak, for some kind of flush out. So it doesn't mean that it's going to happen, but we have to look at this in terms of risks. It is possible that we have 2.5 million coins that are sitting there potentially forming that sell side pressure. They are statistically the most likely to sell. Doesn't mean that they will, but it means that the risk exists. It's something that we just need to assess as we go through this process. So that's really the short-term kind of impact. We've covered how at the moment the accumulation is a little bit softer than usual. We've also covered that there's a large amount of coins that are likely to sell in terms of statistical basis. But now we can look more into the demand side of the equation and what's really going on in terms of the overall supply dynamics. So this is looking a bit longer range. This is not really trying to track what's going on in the next couple of weeks. We're talking about 3 months plus at this point in time. And what we're looking for is the general macro trend still in play? Are we seeing overall investors accumulating rather than distributing? What is the big picture view? So my favorite tools to do this is the HODL Waves and the realized cap HODL Waves. Now, these are kind of a similar construction, but they actually map onto a different denomination. So let me explain what I mean by that. So the HODL Waves looks between 0 and 100% of the circulating supply on a BTC basis. And it looks at how old those coins are. So let's think about this top purple band, which is 10 years plus. This contains Satoshi's 1 million coins. Now, they've never been spent. They have no value, and they were mined when there was no price for Bitcoin. But nevertheless, they represent, at the moment, they currently represent 12.6% of the total supply. They're not all Satoshi. There's other miners back then as well. But these long lost coins, 10 years old, currently represent 12.6% of the supply. Now, what we can see here is a general downtrend in these warmer colors. Remember that these are the opposite side of the equation. These are coins that were spent 1 day, 1 week, 1 month. So generally speaking, these warmer colors, if we're seeing a downtrend in those warm colors, it's indicating that the coins must be overall getting older because they're moving up into higher and higher age bands. We can see that this yellow band here is actually starting to expand, and this is the 1 to 2 year band. Since the November all-time high, we've gone from 9.7% all the way up to over 18%. So we've seen a very, very large increase in the amount of coins that are transitioning into that 1 year older band. So generally speaking, this is a relatively good looking picture because we're seeing that we've got a overall reduction in these warmer colored coins. In fact, coins under 3 months old are now at an all-time low, which means that coins older than 3 months are at an all-time high. Now, we spoke about long-term holders being 155 days or 5 months. That means that a lot of those coins that are now 3 months are very soon actually going to be progressing into the long-term holder supply. So we're seeing that most likely there's a lot of long-term holders in the making within the market. But again, that doesn't necessarily mean that we can't have some kind of capitulation event if the short-term holders do in fact start to liquidate. So there's an interesting balance here where the longer term looks better and looks more constructive, but we still have this risk in play. Now, the realized cap HODL waves, you can see that we don't really have a purple band. So Satoshi's coins, because they have no price when they were mined, they're actually discounted. So the realized cap HODL waves is very similar to the HODL waves, except instead of being relative to the BTC circulating supply, it's relative to the USD realized cap. So we're looking at how much value is stored in each of those age buckets. Now, what we can see is that there's a very, very large amount of dollar value stored in these younger coins. And this makes sense because people have now accumulated coins for over a year up here in this 30,000 to 70,000 price range. So a large amount of the capital that's been invested in Bitcoin now exists within probably up to about 1 year in terms of total coin age. So we're sitting there at this point where there's a lot more dollars up here. And this kind of speaks to the cost basis. The overall market's cost basis is much higher at the moment, which is both a good thing and a bad thing because it provides a level of support, which we see in the realized price, which is down at 24,000. But it also shows that there is demand up here. So it's kind of, there's both sides of the equation that we do have support, albeit it's lower down. But simultaneously, it's showing that there is demand for people to accumulate up at these higher levels. Now, just to close on these two metrics, note that we have had a recent minor uptick in some of these darker red colors. Now, this aligns with what we saw with our spent volume up here, and it aligns with our binary Coinbase destroyed. Now, interestingly, we haven't seen price break to new local lows yet, so it's showing that there is enough demand at the moment to absorb this sell side. But the risk is that we have all of these short-term holder coins in loss that could add to that sell side. So we're in a very delicate balance at the moment. The bulls are managing to hold the floor, but we still need to see whether people actually panic and perhaps a downside flush is still on the cards. So let's try to just understand all of the risks as they stand at the moment. Now, we're going to close out on a bit more on the demand side, looking at what we're seeing in terms of accumulation behavior at the moment. Now, what we did see last week was a very, very large, over 31,000 BTC on net withdrawn from Coinbase. We can see that it's kind of this, I've been calling it in my head like whale cost averaging, so to speak. We can see that it was very, very strong through the first part of 2021. It softened out through the rest of the year, but we still see these fairly substantial outflows. And this one was no different. This was a very, very large amount. So what we're seeing is there is still that demand there, but it's a little bit more sporadic. It's not quite as extreme all the time. The other thing that we can see is our illiquid supply ticked higher. So this uptick in liquid supply, which is more or less on the same par as these coins that were flowing out, indicates that the coins most likely moved into a wallet that has low history of spending, little to no spending history. So it is more likely to be some kind of accumulation. It's more likely to be some kind of institution that's taken those coins and put them into some kind of custody arrangement. It does show that we have confluence. But again, what we really want to see is, does this trend continue? And one withdrawal from an exchange is not necessarily the be all end all. It's just one signal of demand that's going on. Now, to look at this at a slightly larger scale, this is a metric called the illiquid supply shock ratio. This is one that Will Clement came up with back in 2021. And what it's looking at is, of that illiquid supply that we just looked at, how much does it reflect relative to all of the rest of the supply? So we have liquid and highly liquid. They typically describe coins that have a greater history of spending. Think about exchange hot wallets or traders, people who are moving coins around on a more regular basis. Whereas a liquid supply is more along the lines of the dollar cost averager, people who are sticking coins in their cold storage and they sit there dormant for many years. Now, it doesn't mean that they're going to be there dormant for many years. It's purely based on the wallet's spending history. It's not based on time, but it does give us a bit of an idea. So let's describe what we're seeing here. We've seen the illiquid supply shock ratio decline. Now, when this metric is declining, it's showing that coins are coming back into circulation. They're being spent out of cold storage, coming back onto the market, and the demand needs to step in and absorb it. So we saw this all the way through the 2018 bear market. There was a lot of coins coming back into circulation, which therefore means you need more and more demand, and thus price is falling to meet that demand to absorb. During the 2018 and 2019 period, however, and into 2020, note how we started trading sideways. This is kind of showing we're reaching it was clearly a break in this downtrend. This is coins coming out of the cold storage into circulation. This is a balanced demand. It was a long-term accumulation period through 2019. And then after the 2020 period, we started seeing a very strong accumulation point all the way through to the March all-time high, the April all-time high, sorry, where we saw another flush out of new coins. So this is generally an accumulation style patterns, dollar cost averaging, people taking coins off the market, sticking them into cold storage. We then had a major flush out where many of these coins got sent back into exchanges. The market had to realize those gains. And really, we had a period of severe correction. We had a more than a 50% drawdown, and we had a miniature version of this 2019 re-equalization. Now, since then, we've had our rally up to the all-time high in November, and note how this metric just continues to grind higher. It's not quite the same steepness we had in 2021. This is a full bull market accumulation period. It's a lot shallower, but it is still continuing to tick higher, including the recent coins that were accumulated this week. So we can see there's like an undertone of accumulation that still does exist using this metric. And then the last one that I want to cover is a slightly more advanced metric. And this is actually a new one that we at Glassnode, in association with Dave Puhle, released during this particular newsletter. So if you haven't seen this in the actual report and you want to do a bit more of a deep dive and understand why it is, what it's actually doing and telling us, I do recommend jumping into the Week Onchain newsletter. And there's a section at the end that will explain what's going on. So what we're looking at here is two different traces. We have our inflation rate in yellow. Now, this is really the amount that we assume is sell side. Some miners can hang on to their coins, but we are assuming that this yellow is an inflation rate. Let's just pretend that that's all being sold because of the proof of work energy costs. So at the moment, we have what we call a nominal inflation rate, which is currently sitting about 1.8%. So that means that miners are selling 1.8% of the circulating supply every single year. Now, what we also know is that long-term holders are in the market at all times, buying and selling. So when we see periods during the bull market, let's take the 2017 bull, note how this green metric, which is looking at the amount of long-term holder inflation, it increases quite substantially. Now, what this is actually showing us is that long-term holders are selling over and above. So it's actually selling more than what the miners are issuing. So when we add together the miner sell side and the long-term holder sell side, we actually have a net inflation rate of 22%, which is very, very significant. That means that 22% of the circulating supply is coming back onto the market every single year. So you can see why this actually puts in a market top. And we saw the same here back in 2013, an effective rate or a market rate of 10.8% and another one up here at 12%. So large amounts of supply coming back onto the market over and above the amount that miners are selling. Now, the converse is also true. Note that during the 2015 bear, as we got right down to the absolute bottom, we were down here with an effective or a market inflation rate of 15%, minus 15%. Back here in 2018, minus 14%. At the very start of the 2020 run, we had minus 5%. So what this means is that long-term holders are buying all of the issuance, and then they're adding another 15% worth of supply that they're taking off the market. So we can actually start to see that we get these large accumulation periods at the bottom of bear markets. So where are we right now? We are in a period of massive deflation. We're down here at around minus 11%. So that means that the long-term holders are accumulating all of the issuance, and then an additional 11% of circulating is coming off the market every 12 months, which is quite remarkable. And you can see that we are continuing on this trend down. We mentioned before that there's lots of coins that are in that 3-month-old band and continuing to mature. It's likely that we're going to see this metric continue to descend. So this is really giving us a long-term accumulation picture. This is a longer range view that shows that it still remains very constructive, and there are people who are still accumulating at these prices, even if it may not be being reflected in price at the moment. So it's this interesting balance of short-term versus long-term expectations. So thanks for tuning in, everyone. Hopefully you found that useful. It is a very challenging market at the moment. It really could go either way. The bulls and the bears are really squeezing price into this consolidation range. In the short term, we have had a weakening of the spending and the accumulation patterns. It's a little bit more bearish than it has been over recent weeks. However, the long-term accumulation still remains exceptionally strong. So it really is about understanding that time frame and what it is that you're actually looking at when you're checking out these metrics. Now, in terms of the metric of the week, I would strongly recommend that you become familiar with the binary Coinbase destroyed metric. This is an advanced tool, and I usually put some kind of 7-day moving average on there. And you can see that you get these spikes higher and lower during more bearish accumulation, during bull market distribution. And where we are at the moment is something a little bit in between, which can make it a little bit more challenging, but certainly watching for if this trend ticks higher, which would be more bearish, or if we see it tick lower, which would be a more bullish observation. So thanks for tuning in. Do give us a share and a subscribe. We really do appreciate you spending your time here. And I look forward to seeing you on Friday. Cheers.